This is the Asia Trade. I'm Shery in Tokyo. The top stories this hour. Oil gains as a deal to reopen the Strait of Hormuz remains elusive. President Trump signals patience even as Tehran rejects direct talks with the U.S. Asian stocks set to open higher as traders digest Friday's U.S. jobs data. SK Hynix stays in focus as he ramps up new fab construction with a potential share buyback also on watch. And Apple is reportedly testing Chinese memory chips across its product lines as a supply crunch bites.
I'm Haidi, Stroud-Watts in Sydney. Take a look at the setup for trading across Asia. And as Shery mentioned, it's really going to be that dominant impact of what we saw was a miss on those US jobs numbers, the implications for the Fed and whether that sort of shakes up the timeline for those expectations. But to that point, we are seeing a modest upside when it comes to trading in US tech futures there, Kospi futures. That's lent a little bit of upside there when it comes to the start of trading in Korea. In Japan, we're looking quite flat at the moment. Dollar yen at that 157.93 level. We are expecting to see sort of a little bit more continuation when it comes to how well those short dollar trades have been building over the past couple of sessions. Switching out the boards, and we're continuing to kind of see that dragging of the heels on the deal over the Strait of Hormuz continuing to remain very much elusive, with crude extending those gains. Brent crude last traded higher by 1%. We're seeing New York traded crude up by 0.8% there as well. So for Brent, we're up more than 5% over the past 3 sessions, and clearly that risk of re-escalation remains high in this space, Shery.
Heidi, let's actually discuss the details of what's happening around Iran, because the final deal to reopen the Strait of Hormuz remains elusive between Iran and Oman. Tehran has ruled out direct talks with the U.S., but President Trump says Washington can wait for Iran's economic suffering to soften its stance. For more, let's bring in Bloomberg senior editor Wendy Benjaminson. Wendy, what's the calculation here from President Trump, given that Tehran does not necessarily want to engage?
Well, I wouldn't want to risk trying to figure out what President Trump's calculations are. But today his position was that that the U.S. can simply wait. He did cite high Iranian inflation and economic suffering. And, you know, their inflation right now is hovering around 70%. And so, you know, obviously that's very hard on the Iranian people. So he is saying today, and he said this in a brief phone call with Axios, so he hasn't, you know, reporters who were traveling with him didn't, you know, engage. I mean, didn't engage in conversation with the reporters traveling with him. So we haven't heard from him directly. But he suggested in that brief interview with Axios that he will simply wait for Iran to get to the point where they have no choice but to negotiate with the United States. Iran, for its part, simply says, you know, we're fine. We're not, you know, until you go back to agreeing to the memorandum of understanding that we signed in June, we have, you know, no reason to talk to you. And as you mentioned, Shery, there is those Iran-Oman talks going on to open the strait. And the foreign minister of Iran, Abbas Araghchi, said they're getting close, but we haven't really gotten a readout from anyone on that yet either. So we'll see what this week brings.
What are we seeing in terms of Iran's renewed conditions when it comes to engaging with the U.S. and what's going to happen with the Strait of Hormuz?
Well, their position in the talks with Oman was that they would administer the Strait of Hormuz and they would charge tolls. We don't really know what the Omanis' position is. The Omanis are more receptive to the idea of U.S. escorts. Iran has said things like any U.S. and Israeli flagged ships would not be permitted to go through the strait, except there are no U.S. or Israeli flagged ships, really. U.S. oil produced, you know, consumers get it from ships flagged by other countries. So we don't really know what's happening with the Strait of Hormuz beyond that.
Do we have any idea what's happening with another U.S.-backed regional diplomatic track when it comes to Gaza and the conversations with Israel?
That one is a little more certain because Israeli Prime Minister Benjamin Netanyahu just simply came out and said, no, I don't agree to this deal at all. This was a deal that Trump announced through this Board of Peace that he set up for Gaza, that would call for Hamas to disarm and then Israel to back away from the Gaza Strip, where it is still occupying a large part of it. And then there would be peace and a two-state solution between Israel and the Palestinians in Gaza. Well, none of that has happened so far. In fact, Israel is still crossing the line that I think you were just showing there on the screen, the yellow line. Israel keeps crossing that line into Gaza territory. Hamas has not disarmed. And now Netanyahu, who faces re-election in October, simply says he's rejected this deal out of hand. Remember, he was never a party to this deal. And so Trump is in that position where he likes to, as he does domestically in the U.S., simply announce that this is his policy and this is the way it's going to be. He doesn't check with Congress. He doesn't, do a lot of polling or anything like that. But he's trying to do that internationally, and other sovereign nations are pushing back.
Bloomberg senior editor Wendy Benjaminson, as we continue to watch that Middle East space for further developments. And in the meantime, Wall Street traders, broader markets digesting signs that the US Treasury is eager to keep bond yields from spiking higher. This comes as recurring supply shocks make sticky inflation harder to miss. Let's bring our equity strategist, Sunny Banjer, for more. And so we're also digesting, of course, the miss when it comes to payrolls. Do you think this meaningfully changes the path ahead for the Fed?
Yeah, absolutely. It definitely puts an interesting dynamic ahead of the CPI data in midweek. What it's sort of now transpiring to is that the jobs data has had only 34,000 job growth over the last 12 months in the US, which is obviously quite below the trend that the Fed would like to see. So it definitely keeps the Fed on watch, and obviously markets reacted positively to that, with gold in particular rallying on Friday, anticipating possibly that the Fed's more on hold, waiting for CPI data, and then we can assess what the next moves are. And obviously the other core part of CPI that we will be watching is the shelter inflation that the Fed's made some noise about over the past few years. Still remains very much in check.
That inflation picture obviously further complicated by the fact that we don't have a clear kind of see-through as to what happens with energy flows, right, with the Strait of Hormuz. Are investors paying much attention to that at the moment, equity investors?
Yeah, it's a good question. I think there was a lot of focus when this conflict first arose, not knowing what it really meant, how tight energy markets will be. I think the energy markets to some level are anticipating that eventually some deal will be struck. So the reaction even this morning with oil up just about a percent or so doesn't necessarily mean that investors are very fearing of the outcome. I think they're still thinking that there's going to be some deal on the table, and they're trying to look through the tension in the Middle East and other macro economic indicators, and obviously earnings out of Wall Street.
We've also had inflation numbers out of China that clearly show that the broader economy outside of tech is still lacking these demand-driven catalysts, right? But tech is clearly the focus here. What should we be kind of preparing for in terms of how far Beijing is willing to go to support these AI champions?
Yeah, I mean, obviously, China has taken a very different approach to the stock market, the capital markets this year, with many Chinese AI leaders listing. There will be more. They'll have a robotics company, Unitree, also listing. So clearly, China is taking a positive view that they want the capital markets to support the growth in AI. And look, this is a new era of China tech. We've gone from China solar, wind, battery, wherever China enters in, essentially drives profits in that industry to zero. And now we have China AI tech. And obviously that worries some of the leading frontier labs in the US. At the moment, it looks like to be a two-player or two-type of market, at the very high-end tokens and then at the medium of low-end. But notwithstanding, this is a very important development for global AI as China moves its models into the world. And, at the moment, most of the usage of tokens is in Chinese AI models.
Bloomberg equity strategist Sunny Bangia with us this morning. Still to come, Westpac's international economist Illiana Jain joins us with her macro outlook for Asia, where she expects the RBA to hold for the rest of the year. This is Bloomberg.
We're in a zero-ish workforce growth environment, and we're in a zero to modest positive jobs growth environment. That didn't feel very good, but that is, I think, where we are, and it's, I think, been pretty consistent in my mind over the last year and a half.
When they summarize this, years from now, you're gonna witness something that is productivity. People say it's AI kicking in. I actually think it's just been an ethos around companies growing their business and seeing how you can operate without that much employment.
We have a very K-shaped economy, and that's not very good for for people selling to the broad mass of consumers, but it's very good for those who are essentially the beneficiaries of the spending of the very rich, because what do the rich do? Well, they buy stocks and bonds,
right.
And that's been pouring money into the market. So I think the market is really outperforming the economy by a lot.
Some of our guests here on Bloomberg TV reacting to Friday's US jobs report. And joining us now is Illiana Jain, who's the international economist at Westpac. So what were your takes away? Because clearly that has caused a rethink when it comes to where the Fed can go from here.
Yeah, certainly. Look, the jobs numbers really confirmed what we had been talking about for quite some time, that the headline numbers were really masking a weak economy under the surface. So we saw a decline in non-farm payrolls, but I think the one thing to focus on is the unemployment rate and the participation rate. We've seen the participation rate fall for the most part since 2023, and that's meant that that's really flattered the unemployment rate to be lower. But if we hold the participation rate at where it was roughly at around 2023, which again is lower than where it was prior to the pandemic, we would have an unemployment rate closer to 5%, and that certainly speaks to a labour market and economy that has a bit of slack in it. So overall, we do think we took that read to be a confirmation of what we think, that the underlying labour market is actually quite weak, and we do expect that the Fed will remain on hold for the foreseeable future due to that.
So it makes this week's inflation read ever more interesting. Are you surprised that we haven't perhaps seen as much pass-through from the Middle East oil crisis?
For the US, I think it has been a little bit surprising, but this pass-through has still definitely been there. I mean, if you see the last couple inflation prints, they have been on the stronger side, even though we have seen a bit of easing in the services side, and that strength in inflation is probably what's going to keep the Fed on hold and not necessarily cutting rates. As for the CPI data we're getting this week, we do anticipate it's going to show the impacts of that re-escalation in tensions, but we don't anticipate that a lot of the discretionary categories, things like recreational services, are going to see much renewed strength. So while we do see the headline number, there is a bit of risk that it comes in a bit stronger than what markets are expecting. We don't think the underlying will point to renewed inflationary pressures.
For the RBA this week, the consensus, at least here at Bloomberg, is for a hawkish hold. The stubbornness of the inflation readings, or I guess the slowness of how the disinflation effort is coming through, how does that balance with factors like the fact that we're seeing a really big slowdown in the property market?
Yeah, sure. So I'll start with inflation first. So you're right in that we've seen inflation be quite persistent, but I think it's worth noting that inflation, while it has been persistent, it hasn't reflected a strong transmission of the higher costs a lot of businesses are facing. And in contrast to the US, I think that's a very good news story for the RBA, and that's something that has led us to change our call for the RBA to remain on hold for this year and into the first part of next year as well. And so while we can say, well, inflation's been quite persistent, I think I like to see that number is a good thing because it hasn't actually passed through a lot of the costs. In terms of the housing market, we are expecting a sharper slowdown than we were previously. The combination of higher rates as well as the tax changes we saw this year have led to a much sharper contraction in house prices, particularly in capital cities like Melbourne and Sydney. And so for overall, we do expect a decline in house prices for 2026 in Australia, but a lot of that's going to be driven by the capital cities like Melbourne and Sydney.
Have you started to see that feed through when it comes to consumption or sentiment data?
Yeah, certainly. Sentiment's been incredibly weak. And consumption, while the most recent household indicator suggests that it's been pretty strong, the underlying pace has been quite weak. We look at internal data here at Westpac. We look at customer data that reflects both the spending and savings side. And we saw that spending actually did slow down. It was boosted by a lot of airline refunds, so people getting refunds from not being able to travel. And we think that may have contributed to some of the strength that we saw in overall spending. But the underlying pace has been quite weak if we kind of look at spending on an ex-transport basis. In terms of the savings data, I think that's where the really interesting part comes in, because we saw that a lot of consumers have quite healthy buffers, particularly ones with mortgages. And those buffers were nearly as strong as what we saw in 2022 prior to the rate hikes. So consumers are in a pretty good position, but their lack of confidence in the economy is really what's leading them to slow down and hold back on excessive spending.
Confidence, is that still an issue for China? We see that sort of demand-driven reflation really starting to weaken in the latest inflation readings.
Yeah, certainly. I think for China, that confidence story is quite important. And why Chinese consumers lack so much confidence, it's not hard to see. I mean, their main source of wealth was housing, and the housing downturn the last couple of years hasn't been great for that. On the flip side, the labour market hasn't been particularly strong. During previous expansions, particularly industrial expansions, where we saw big growth in exports and industrial production, that usually translated into labour market growth as well, because you have to hire more workers to make more products. But this time round, because a lot of the growth is coming from the high-tech manufacturing sector, that doesn't require as much labour, it's more capital intensive. We've seen a slowdown in hiring, and that's really dampened consumers. So for China, the main issue is making sure consumers don't lose their confidence completely, and for that not to turn into a structural factor of the Chinese economy.
So the K-shaped recovery continues. Do you expect more fiscal stimulus, or do you think at this point it's something that China is comfortable with?
Yeah, recent meetings suggest that maybe fiscal stimulus in the way we saw in 2025 probably won't be a thing. I don't expect a lot of cash handouts to come through 2026. That said, it doesn't mean that Chinese consumers don't need to be aided with fiscal support. What that fiscal support really should be doing is helping bolster confidence. One way of doing that is helping support the equity market and encouraging consumers to invest into the equity market, because that allows them to share in on a lot of the gains in the tech sector rather than miss out.
Illiana, always great to have you with us. Illiana Jain, who's the international economist at Westpac. More ahead here on the Asia Trade. This is Bloomberg. Shares of Sunrise Energy Metals will be in focus when Aussie markets come online a little bit later. This after President Trump announced a $3 billion investment in critical minerals mining, hoping to wean the US off China-dominated supply chains. Paul Allen joins us now for more. So what was in that announcement, and how does it impact Sunrise in particular?
Yeah, good news for Sunrise. There's a lot of elements in this story that we might be hearing for the first time. Sunrise Energy, not a company would normally cover, mines scandium. not an element we'd normally think of. That's used for strengthening aluminium, also has applications in data center energy supply. So some obvious interest there. And it does this in the town of Fifield, which is, again, where's that? Tiny town, 6 hours west of Sydney. So this is where scandium oxide is mined. Nearly all the supply at the moment comes from China, Russia, or the Ukraine. So the White House over the weekend, our time, described Sunrise as the world's first primary scandium mine. And the CEO, Sam Riggle, he's a former Rio Tinto executive, says this project in Fifield could replace all of Chinese supply in one hit, hence the interest in this from the White House. So they've received a $400 million loan to expand production, and that would put the United States at the front of the queue when production does begin. That's scheduled for late 2028.
We also saw some of the more household names in the sector, reps from BHP, Rio Tinto, also at this announcement. What was in it for their portfolios?
Well, they were there largely to talk about the Resolution copper mine, which is another very large project. That's in Arizona. Once that's developed, it will be the largest copper mine in the United States. It has the potential to satisfy about a quarter of US copper demand. There's also a number of other co-products from that mine in the rare earth space, molybdenum, tellurium, indium as well. So again, of great strategic interest to the US. So there's already been announced an investment of $500 million US. The legal battles that have beset that mine for, well, a decade or more now seem to be overcome. So the US government's trying to fast track this process to production there targeted for mid-2030s.
Paul Allen there joining us from Sydney. Now, the top global headlines that we're following as well. The Pentagon is pressing major defense firms to speed up production of key weapons and missile defense systems. Deputy Defense Secretary Steve Feinberg asked companies to submit plans by late August for faster deliveries and increased production capacity. Concerns are rising about U.S. weapons stockpiles following the operations against Iran. However, President Trump has denied the U.S. is running low on munitions. The Trump administration has introduced new tariffs and price floors on polysilicon and other key components used to make solar panels. Under the move, imported polysilicon derivatives, including silicon wafers, will be subject to 15% tariff starting in December. The move is aimed at stopping Chinese-linked manufacturers from shifting production to new countries to sidestep existing U.S. trade restrictions. The U.S. Senate has passed a short-term spending bill to avert a government shutdown, sidestepping Trump's calls for emergency Iran war funding and new voter ID measures. The bill would keep the government funded through December 11th and now heads to the House, where lawmakers are expected to take it up later this month. Take a look at how we're setting up with U.S. futures after 2 weeks of gains for U.S. stocks. We're looking at downside of about 0.1% for U.S. futures as the U.S. dollar remains steady. Remember last week, we actually had big tech reclaiming leadership. Microsoft, Amazon turning the AI capex fear into a revenue story. But can this be durable will be the key question. Of course, across Asia, we'll be following some of the suppliers, some of those chip makers as well. When it comes to the U.S. dollar, we saw a little bit of gains earlier in the week, but then downside later in the week around Friday to the lowest since May. Payrolls, the latest numbers coming from the U.S. Showing how it was softer than expected, Haidi. That reset the expectations for a Fed rate cut in September. The odds now at around 40% down from about 60%. So we'll be following the Treasury rally that we also saw in the U.S. session.
Shery, this has enormous implications, obviously, for the yen, right, which is really so much, as we've seen over the past few months, at the mercy of the differential between the US and Japan, or I should say between the Fed and the BOJ. So those sort of oscillations is where we've seen the yen following as well. We saw it edging lower against the dollar in the Friday session after the strengthening in the dollar there, but bonds likely to rise there as well. Aussie yen is a pair that we're watching, analysts seeing it approach a 3-decade high as we see the impact of the intervention fading. In a way, it feels a little bit like we're at Groundhog Day again when it comes to these Middle East negotiations, right? We're sort of inching ever closer to that deal between Iran and Oman over reopening the Strait of Hormuz. But when it comes to these conditions with the US, these seem to be the main sticking point as we continue to see oil holding onto those gains. Brent crude last traded higher by 1%. We'll wait to see how that goes at the open. But over 3 days, we saw that 5% gain there. We are hearing that the US has now, Iran, I should say, has now rejected further talks with the US. President Trump doesn't seem sort of too bothered about it. He told Axios in a report saying that the US is low-keying it. He's pointing out to the high inflation levels for Iran, the fact that, quote, he thinks they have no money. So clearly that sort of economic pressure is perhaps one strategy that he's using just days after we saw that re-escalation of airstrikes against Iran as well. So we're watching that front pretty closely. In the meantime, we're seeing US futures off by just about 0.1%. That repricing of Fed expectations, Shery, is obviously a key point given that we had the miss in US payrolls. And Japanese equities, we're seeing upside of 0.8% in that futures session.
And take a look at how South Korea is setting up. Of course, you talked about Groundhog Day when it comes to these tensions around Iran. It's the same with the volatility in South Korea. We, of course, have seen 6 weeks of losses for the Kospi already. Volatility, yes, has been retreating a little bit, at least from that record high. Leverage is being flushed out. But the issue right now is the foreigners have been selling. So you're seeing the won a little bit supported lately because we have seen corporate dollar repatriation. We have seen SK Hynix now committing $38 billion to more memory capacity. So that chip profit boom that South Korea is seeing is now feeding directly into FX support. Not to mention that, take a look at SK Hynix futures setting up like this. We're still watching the company for any firm announcements when it comes to share buybacks. Kospi futures at the moment pointing to some upside. So we could see a little bit more stability in today's session, but let's discuss with Bloomberg's Asia stock reporter Yu-Kyung Lee, who joins us now from Seoul. And Yu-Kyung, I mean, we are seeing volatility retreating a little bit in South Korea, but the reset in that market has been historic.
Yes, absolutely. So South Korea has been one of the most, if not the most volatile market in the world. It was more volatile than Bitcoin by some measures. But we're seeing that extreme phase of volatility and it might be over. We've seen historic sell-off of 40% sell-off down, 40% down from its recent peak, and that has helped flush out a lot of leveraged excess in the market. And some of the signs include the volatility gauge of Kospi, known as V-Kospi, has fallen to the lowest level in about 2 months, below 80, which implies lesser of the volatility in the cash market. And other indicators also include the leverage, the forced liquidation. We've seen 1 trillion won worth of forced liquidation in the month of June, which is the highest month this year, and that has helped reduce the margin loans. The margin loan level has reduced to the lowest level this year at the end of August. So all these point to the the extreme phase of volatility may be over now.
So we have seen, though, because of the sell, valuations fall in South Korea. So these stocks are pretty cheap. Why aren't foreign investors coming back in droves?
Yeah, we've been asking that question to a lot of foreign investors last week, and the potential expected return may not be high enough, even though the valuation has become really cheap to justify the level of volatility. It's important to note that even though the extreme phase of volatility may be over, the volatility still remains pretty high. So we may still see some intraday gyrations in the Kospi during the cash market trading. So it's not at the level that would make foreign investors feel fully comfortable, to quote one of the investors that we've spoken to. So so we're not seeing foreign investors rushing back in, and they've been still selling Kospi cash market during the month of August, even though the level of selling has moderated from the record number in June. So we still need to see that volatility level ease further to see that global investors rushing back into Korean market despite this cheap valuations.
Bloomberg's Asia stock reporter Yu Kyung Lee there. Well, some of China's tech giants are set to report earnings this week. The focus will be squarely on how they justify their AI spending. Tencent spending plan set to draw investor scrutiny there. Also on tap, we'll be hearing from Foxconn, expected to report their first half profit growth of 93 to 101%, driven by strong demand for AI servers from cloud providers. Bloomberg Intelligence thinks that Lenovo's AI server division is expected to remain its primary growth engine, supported by strong demand and a $21 billion order pipeline. Staying with China, and Apple is reportedly testing memory chips from China's CXMT across its product lines. According to the Wall Street Journal, the company is hoping to win Washington's blessing to do business with the memory chip maker. Let's bring our China correspondent Min Min Lo in Hong Kong. So it's obviously been a big couple of weeks for this company. What are we hearing in this report?
Yes, according to the information, Apple is already in early talks with CXMT to acquire some of its chips and components to use in everything from its iPhones to its iPads, particularly for products that are being sold in China. And it's also Apple reportedly looking for the blessing of the White House to do so because, of course, CXMT has been blacklisted by the Pentagon, which means that U.S. firms cannot transfer technology to CXMT. And this includes any communication around technical details, around product specifications. So this means that if Apple were to work with CXMT, it will not be able to get custom-made chips from CXMT. It will only be able to get those off-the-shelf chips. And it could also mean that Apple may have to redesign some of its product parts in order to integrate those CXMT chips. And this is, of course, coming amid reports that other firms like Acer, like HP, are also reportedly already using limited quantities of these CXMT chips and are looking to lock in further supply for next year. So it just shows you that, Chinese chip makers are making huge leaps to become more competitive on this front amid the memory supply crunch.
And so much of this ambition is going to come down to what happens in China's capital markets, right? What are we seeing in terms of Beijing's push here?
Yeah, so when it comes to AI, obviously it's a very capital-intensive industry, and so raising funds has been key to fund that AI raise. And in China, a lot of that funding is increasingly coming from the capital markets, and there are a couple of reasons for this. One is that local governments, of course, have been saddled with these local government debt. Their priority is to refinance those debt or to pay them off. While banks are sometimes quite reluctant to fund companies that are still in early stage growth, that are not yet profitable. So these companies are starting to turn to the equity markets, to the bond markets, and we have seen how government agencies are working together, whether you're talking about the PBOC, the CSRC, the economic planner. They've come up with a slew of measures to support that, right? Whether it's intervening with unusual speed to stabilize the stock market, or creating more channels to raise or to issue bonds, particularly for new borrowers, or whether it's fast-tracking some of these strategic companies for their IPO approval. So these government agencies are working together in a coordinated approach to really support Chinese fundraising. But if you look at the statistics, though, for every $1 that Chinese companies raise, U.S. firms are raising $6. So still dwarfing the rate of fundraising from Chinese firms. But that gap is clearly something that China wants to close.
Bloomberg's China correspondent Min Min Lo there. Let's turn to the U.S. markets because weak U.S. jobs and the strong U.S. tech lead are setting up a positive session for Asian risk assets. Bloomberg Markets reporter Anthony Stevens joins us now with the latest. And Anthony, what was really interesting in the last few weeks has been that really reversal of AI leadership, whether I'm talking about Microsoft, Amazon versus the Alphabet story, for example. Is this a real, durable sort of institutional re-rating of the tech story, or are we just talking about positioning? Because that will have implications for Asia, right?
Absolutely, right. And that's why today is not a simple read-through into Asia. So just to reference what you spoke about yesterday, the revival of the Mag 7 in getting market leadership. And that is being driven, as you said, by the hyperscalers on the software side. So as token prices come down, you're starting to see a kind of a fundamental shift back into the people producing AI. And people talking about the cost of using tokens to produce software is going down. As a result, more money can be hung on to by the people producing AI AI-related work. So that's obviously helped Microsoft. It's also helped Amazon and Meta and these kind of names recover versus the semiconductor index. Meanwhile, there are these margin concerns along the semiconductor space. There are these concerns of over-positioning in semiconductors, and also some concerns around shareholder return, most notably in Korea from semiconductors. So it's a very good point for you to highlight this kind of transition, and it's not really helpful to Asia. The second topic is a lot of the US moves on the upside have been driven by short covering in the software side. So we saw huge gains in SpaceX, in Palantir, and in the software ETFs more generally, and that is not that helpful to Asia. And as a result, you see this kind of muted / mixed leads into Asia. Most notably, the Hynix ADR was quite weak overnight as they continue to expand capacity in Korea. So how that plays out in Asia is going to be super interesting. Will Hynix break out of its slump? It's being supported by, the Korean index has been supported by Samsung while Hynix is weak. How long is that going to continue? And will Japan see a very easy read-through from US strength or not?
And Anthony, what's been really interesting for me has been this whole China tech AI story as well, right? I mean, we've talked about Taiwan, South Korea, US tech, and now we're seeing all of this enthusiasm around CXMT and their Shanghai debut and so many other names with potentially huge gains from now on. What does this sector look like in terms of opportunities?
Even for the Chinese, it's getting a little bit complex, right? So the progress they are making is disrupting their own stock market. So, for example, all these optimization on the LLM side has really hurt the China semiconductor space on a share price performance, even though the ecosystem feels a lot healthier. On the other hand, you have unlisted players like ByteDance make huge progress on the LLMs, and that's also been making the share prices of the LLM space extremely whippy. So we almost have a new model from China every week. That LLM space is very volatile, up or down 10% pretty much every day. CXMT is making these huge strides in memory, but at the same time, this optimization of memory usage is kind of capping how much shares can move from here. And then we have continued fundraising in the Hedge share market from names that are listed in the Asia market. So from a flow perspective, China is extremely complex at the moment. We have Montage's listing and share unlocks from other players as well coming to the market today. So extremely interesting space. There is a diversion between software and hardware recently, with software doing quite well. HS Tech has rallied quite sharply. And this earnings season, with around the pretty much 90% of China's market cap reporting in the next 3 weeks, that will really highlight what is happening in China.
And Sarah, Bloomberg Markets reporter in Hong Kong. Well, coming up on the Asia Trade, Japan's fiscal policy will be focused next in our Japan Ahead segment. We'll be interviewing Waseda University professor and the former BOJ Deputy Governor, Masazumi Wakatabe. Let's take a look at what we're watching when it comes to the commodities front, because clearly we continue to see that extension of gains in oil prices as Iran and Oman remaining short of a deal to reopen the Strait of Hormuz. We're seeing Brent trading above that $84 a barrel level. It's climbed more than 5% over the past 3 sessions. So the risk of a renewed re-escalation of a flare-up across the region remains high. Markets clearly very much still on edge. We also had Houthi militants claiming responsibility for an attack on a Saudi refinery near the Red Sea over the weekend as well. In the meantime, it was quite a week for copper last week as we continue to scale these highs. The market crunch appears to be brewing. If you take a look at that pricing, we've got 0.2% higher now, and indications that the market is tightening fast. A surge in shipments to the US, rising orders to China, potentially setting the stage for that extended rally. We could see all-time highs there. Futures in London have pushed past that $14,000 a tonne level already. More ahead on the Asia Trade. This is Bloomberg.
For the opens here in Japan in about 15 minutes, we've been seeing the yen with a little bit of strength against the U.S. dollar, given that we got that soft U.S. jobs report. We had Treasury yields down, the dollar down, so we had some gains for the Japanese yen, past that 158 level, headed towards 157. But still, the gains that we saw from the U.S.-Japan joint intervention remaining pretty fragile. We're talking about last week, finishing the week weaker against the dollar. Hedge funds did cut shorts in half, while September BOJ hike odds went up. But still, we're seeing a lot of skepticism about the structural support when it comes to the Japanese yen. Let's discuss what's happening here in Japan with Masazumi Wakatabe, professor of economics at Waseda University. He previously served as deputy governor at the Bank of Japan, and he's currently a private sector member of the government's economic and fiscal policy advisory panel. And as always, great to have you in the studio.
Thank you.
What do you make of the U.S.-Japan joint cooperation and the fact that we didn't get sustainable long-term gains when it comes to the Japanese yen?
Well, I think that's a very brilliant idea to intervene at this juncture. That's the Japan and the U.S. are on the flexible exchange rate regime. So that's basically this is more like the sort of the emergency dealing. So that's it's not we are going back to the fixed exchange rate regime. So that we should expect some volatility and fluctuations down the road. But I think it's a brilliant move because from time to time FX movements are kind of driven by speculations rather than the real demand. So that's from time to time it's okay. I think it's actually appropriate for these authorities to intervene.
What I found interesting is that earlier this year, when Japan intervened on its own, we were talking about the potential that will Washington be okay with it? Because if they actually sell foreign assets, including treasuries, that yields could go up. We keep getting more indications that perhaps Secretary Bessent is not happy about yields going up. In that sense, let me link this to the fiscal policy here in Japan, because we're headed towards an expansionary move.
Sure.
Would that sit okay with Washington, given that it has the potential to also pressure the yen again?
Well, actually, it takes two to tango in a sense. So that's right now what we are seeing is that the dollar appreciation and Japanese yen weakening. So that dollar appreciation, what is driving forces? Clearly tariffs and also the fiscal expansion in the United States, pushing the U.S. dollar to appreciate. So if Japanese fiscal stance is going to be more expansionary, actually the Japanese yen would appreciate. That's what the theory tells us. Why? Because that we are going to have more domestic demands for yen. When that the government engaged in expansionary policy. So if that's the case, that's where Japan's fiscal policy comes in to play. That's where that Scott Bessent actually embraces Japanese fiscal policy stance.
Does it worsen the fiscal outlook and discipline of the government, making markets more skeptical about what Japan is doing, therefore pressuring the yen, also really taking yields to multi-decade highs?
Well, actually, the inflation expectations should be taken closely watched. I think that the inflation expectations are moving up right now in Japan because we are in the middle of reflating the economy. But I think that the more or less inflation expectations are right now stable. If you take a look at the BEI, the inflation expectations measure the market measures, actually that's kind of stabilized. So that's so suppose we have more fiscal expansion. Is that going to be more inflationary? The inflation in Japan has been stabilized so far. So that's that would not give an extra sort of inflation expecting pressure.
The fact is that we still don't have an end in sight to the Iran war, right?
Oh, right.
We have the external potential shock really lengthening from here on out. At the same time, the fact that Japan wants to potentially cut the food sales tax cut for 2 years. 2 years seems like a very long time of what could potentially happen.
Well, external shocks, come and go. And the beauty of this consumption tax hike, the cut, is that right now Japan's inflation is very much stabilized, actually even downward trend. Thanks to several the policy measures. It's the headline for the CPI in Japan is 1.7. Okay, actually it's below 2%. But the food price increased at 3.2%. So that's if the government thinks about the food price increases as a problem, then it makes sense for the government to subsidize, that's the cut the consumption tax on food and beverages. So overall effect, in fact, turns out to be more like a disinflationary.
But then doesn't that also pose a question for how the economy will grow itself out of debt and really prolonging long-term productivity in this economy? So all of the fiscal policies in place right now that are expansionary can pay for themselves. Right now, how that is being funded seems pretty unclear.
Well, I think there are two parts. First of all, the consumption tax, that's a cut, will give extra for the households to spend. So right now, the consumption spending in Japan is negatively related to inflation expectation. When they expect inflation to rise, they actually shrink their consumption. So when the food price goes down, then that would give some support for the household. That's number one. The second part is Japan's Honebuto. That's the next fiscal policy project. That will give a kind of investment to Japan. So that the investment is going to materialize. When it's going to materialize as a productivity capability increased, then that we are going to have a more robust economic growth. So in between, the fiscal policy will support this transition.
Wakatabe-san, really good to have you with us. That was a great explanation, but really looking forward to having another discussion with you. Masazumi Wakatabe, professor of economics at Waseda University, and we'll leave the conversation here because I'm also getting breaking news at the moment. We're getting the Japan current account balance coming in at a deficit of more than $92 billion, $92.3 billion. The expectation was actually for a surplus of more than 1 trillion yen. I'm sorry, this is a yen figure for the month of June. It's also a contraction from the previous month. When it comes to the trade numbers, we're talking also about a deficit of 135 billion yen. This is Bloomberg.
Take a look at how we're setting up at the start of a fresh week, but really the same old catalysts, right? We still have that elusive Iran-Oman deal when it comes to the reopening of the Strait of Hormuz. We've had Iran rejecting further talks with the US, and so we're expecting to see crude continuing to grind higher in the week. We're seeing a little bit of upside for Nikkei futures, pretty flat when it comes to Sydney on RBA week. We are expecting a hawkish hold from the Reserve Bank here this week, and Kospi futures up by 1%, but continuing to see that tech pressure. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens as we're seeing Haidi big tech regaining that AI leadership. Not to mention that we're seeing some repricing of where the Fed is going from here, given that softer than expected U.S. jobs numbers.
Yeah, all of this kind of setting up for a pretty positive session, but I guess the question is how resilient that conviction is, right? Given how much volatility, how much rotation we've seen in the tech trade already. There's also the question as we see expectations of Aussie dollar yen headed to a 35-year high, how quickly that fade from the yen intervention is going to play out too.
Yeah, I mean, we saw a little bit of upside for the Japanese yen against the greenback in the previous session, given that we are now seeing, of course, some repricing of what the BOJ will do later on, not to mention trying to understand where the U.S. coordination with Japan is going. So we're talking about getting past that 158 level against the greenback, but perhaps not necessarily sustained because we are seeing, again, the downside pressure there. You can see the Nikkei gaining 0.4%. We are following those tech stocks, given that we saw that AI leadership return to big tech in the U.S., that AI trade, again, propelling markets in Wall Street. So we'll see how that does in the Japanese session, given that we do have those semiconductor supply chain names here in Japan as well, Tokyo Electron, Advantest, and the likes. We'll also be watching the JGB space. We had a couple of auctions last week, sort of gauging that support level when it comes to these Japanese government bonds. But at the same time, given, of course, that we've been at multi-year highs on fiscal concerns, not to mention, of course, a downside pressure from what we're seeing already in global bond markets, we'll continue to watch the trajectory for JGB yields. We have already heard from the BOJ that they're keeping a close eye when it comes to FX moves. Remember, we had that BOJ really summary of opinions from their July meeting where they didn't move because they had already hiked rates to 1% in June. We also got the trade numbers for Japan. The current account surplus actually fell into a deficit, not to mention that the trade deficit came in larger than expected. Take a look at how South Korea is trading right now, because we have been following the volatility of the Kospi. We're talking about a Kospi drawdown of about 40% since its June high. We're seeing a little bit of upside after 2 sessions of losses for Korean stocks. The Korean won continues to weaken around 1,400 levels. We had seen a little bit of upside from corporate sales, dollar corporate sales that we saw in South Korea. Not to mention that SK Hynix commitment to invest billions of dollars in new fab constructions across South Korea has actually led to a little bit of that support coming for the currency as well. So do keep an eye on SK Hynix, because Heidi, we've been talking about the longest time. When can we see that announcement of that potential share buyback?
Yeah, and whether that's going to really be the next catalyst that we're looking to, right, after in what has been such a volatile space in this market. But Shery, we mentioned a little bit about sort of shifting sands of expectation for the Fed in terms of how we're going to see the path from now until the end of the year. The jobs numbers were really quite interesting because it does suggest, when it comes to the participation side of things, the underlying weakness in the jobs market might be the new focus. That certainly puts renewed focus on the inflation readings that we'll be getting from the US this week as well. But in terms of how that's playing out for treasuries, that focus will be on the inflation data, gauging demand for a fresh set of treasury sales this week as well. We've got some auctions in focus. These yields, though, still holding pretty close to those record highs that we've seen. Treasury futures inching a little bit lower in the morning as we continue to see that deal between Iran and Oman over the Strait of Hormuz remaining still very much elusive. That's obviously playing through to that continued upside in crude. Brent crude coming online up by 0.9%. We're up over 5% over the past 3 sessions. That shipping route through the Hormuz, the deal to achieve that, apparently very close over the weekend. But again, in terms of the bigger picture, Iran has also ruled out direct talks with the US for now due to what they say are violations to the interim peace deal that was sealed back in June. So watching treasuries at the moment, we did see that rally across the curve on Friday, and particularly the yield on the 10-year closing around 3 basis points lower in the New York session on those jobs numbers. We're also watching gold holding on to most of the gains that we've seen as the jobs data kind of eases some of these rate hike concerns for the Fed. Let's bring in now from Hong Kong, Jasmine Duan, who's a senior investment strategist at RBC Wealth Management Asia. Jasmine, always great to chat with you. What's sort of top of mind for you at the moment? There is quite a bit of conversation as to whether these Fed expectations have really shifted going into the end of the year.
Well, we think right now what's causing the rates, the yields volatility is really the Fed's communication strategy. In the past, the Fed communicated to the market very clearly, but now under the new Fed chair, he want the market to figure out things themselves. And in this past Fed meeting, investors expected the Fed to act, but they didn't act. So that kind of caused some confusions to the market as well. And this talk tough but without action approach, we'll only act in the short term. And we think that central banks need credibility, and credibility comes from backing words with actions. So we think Walsh will take the opportunity of Jackson Hole to clarify his approach. And until we hear from him, we expect yields to remain elevated and volatility to persist. And we think the Fed is likely to have the rates on hold until end of next year. But bigger risk comes from inflation if it picks up again in the fall, or oil price goes up again, and that will push the Fed into action.
In the meantime, you remain overweight US equities. Has the recent volatility when it comes to questions over AI spend changed that at all? What are you focusing on?
Well, for us, we remain constructive on the AI story, on the tech sector, as long as the earnings can deliver. And we think if earnings can continue to hold, there is a room for the market to continue to go higher. But we do acknowledge that the AI narrative is getting more complex right now. So first of all, the AI is powering the whole data center build out and broader economic growth. But most of the companies are still saying they see potential for earnings to grow using AI, but there is no actual improvement of their productivity or their earnings profitability improvement. So we see this gap between the hype and result widening. And also, we see an inflection point for the hyperscalers CapEx. For this year, the growth is expected to be 70% year on year, and for next year, the growth will be 30%. It is still a very big number, but the growth rate is slowing down. And for equity investors, they look at the growth rate instead of the absolute level. And therefore, we think we are reaching an inflection point. And now with the cheap AI models coming to the market, that could also extend the ROI timeline for the hyperscalers. So we are constructive on the tech sector, but we are aware the narrative is getting more and more complex.
Well, part of the challenge, of course, the real challenge is coming from China. So do you have any interest in any of the AI names or even the picks and shovels names from the Chinese market?
We do see that it's very interesting. We are hearing this latest news for the cheap AI models coming into the market and getting more and more competitive to their US peers. And that could provide some opportunities because the AI peers, the China peers did look more attractive in terms of valuation, and their growth outlook is looking also attractive. And therefore, we think at this moment of time, the China AI space do present some opportunity. But what's more important to watch is the upcoming second quarter earnings season. So for some of the big tech companies, their revenue may continue to grow or remain stable, but for their bottom line, because of the increased investment in AI, their profitability may be affected. So it really depends on how the company management is going to explain this and how investors will look at this increased investment in AI. So maybe they are happy that there is increasing investment, there are future profitability growth, but some investors may also be concerned about the short-term earnings being affected. So it's really important for us to look at the upcoming second quarter earnings season.
With no resolution in sight at the moment between the US and Iran, do you see opportunities in the energy sector?
Yes, we do. So right now for the US and Iran situation, for us, we remain skeptical that real peace or stable oil market will come back anytime soon. And we think for both US and Iran, they are just pausing, not peacing. And if we look at the nuclear standoff that started the war 5 months ago, it hasn't been resolved. And we think both sides will have incentive to fight again. And also for the shipping market, with the ongoing threats of tolls and drones and missiles, a large portion of the ship market will remain on the sidelines. And now the U.S. Strategic Petroleum Reserve is at its lowest level since 1983. It's just slightly about 300 million barrels. And that means the buffer is really thin, and the wood is hard to sustain another supply shock. And therefore, we think for investors, it's really good to have some energy stocks in your portfolio to diversify the risk as we expect this supply constraint to remain.
Jasmine, great to have you with us. Jasmine Duan, who's the Senior Investment Strategist at RBC Wealth Management Asia. Let's take a look at some of the early session movers that we're watching, particularly when it comes to gold miners here in Australia as well. We're seeing broad upside there, as much as 3.7%. In fact, as much as 6.5% if you're taking a look at Sumitomo Metal Mining in Japan. Gold trading pretty steady and holding most of its gain. The soft US jobs data really wiping out some of these rate hike expectations, the surprise contraction that we had in the payrolls data on Friday. So the Bloomberg gauge of the dollar also dropping. So that gives a broad boost to commodities overall. One of the movers that we're watching is Treasury Wine Estates, flagging a $395 million post-tax write-down ahead of its full-year earnings on Thursday. It is part of a broader effort to tackle supply chain problems when it comes to the American market. So saying that they'd be cutting the size of its US North Coast vintages from 2026, write down on some inventory as well, which would be sold into bulk wine markets to try and improve profitability in the Americas region over the medium term. Clearly, this is something that investors like, despite, of course, that short-term pain of the write-down. We are seeing upside of 5%. In fact, it had been trading the highest in about 9 weeks. More ahead on the Asia trade. This is Bloomberg.
We're really in the middle of the game here. This thing is not over. It's obviously not at the beginning. We're in the middle of the game, and we're applying a whole host of tools, diplomatic, economic, military tools, to ensure that we get the best outcome for the American people. I feel quite confident we will get there, but we're still a bit in the middle of the game.
U.S. Vice President J.D. Vance speaking with Fox News on Iran and how some progress has been made in talks recently. Tehran now ruling out, though, direct talks with the U.S., and the final deal between Iran and Oman to reopen the Strait of Hormuz remains elusive. For more, let's bring in Bloomberg managing editor Jill Deasy's. Jill, I find it interesting that President Trump is now signaling more patience instead of an imminent military escalation. What are we seeing in terms of the different tactics, both from Washington and Tehran?
Yes, good morning, Shery. I think, look, we've been in essentially a waiting game at this point for quite a while now. And while it did seem at the end of last week that maybe there was going to be some progress, even at the beginning of last week, you had Trump saying things like, there would be some kind of a peace deal reached within 48 hours. Obviously, we're well past that point. And now it seems even this potential deal between Iran and Oman to reopen the Strait of Hormuz isn't really making a ton of progress. What we're now hearing from the president, Donald Trump. He spoke to Axios recently, kind of implying that maybe there would be, a bit of holding out on Iran's economic situation, that maybe there is a way to sort of, outlast Iran because of persistent issues involving their economy, inflation. So I do think what you're looking at here is, essentially talks that have stalled, and we're not seeing a ton of progress. Obviously, you did hear just there from the Vice President, J.D. Vance, that there was still some level of progress. But again, the fact that we're not seeing any direct talks does indicate that things seem to have at least stalled for now.
Yeah, when it comes to stalled talks, there seems to be another diplomatic track that we continue to watch, and that's, of course, the Hamas disarmament roadmap when it comes to the U.S. and also Israel having to agree. What's the latest on that?
Yeah, so at the latest on this potential front, so you had the U.S. put forward a disarmament deal involving disarming Hamas, removing Israeli troops from the Gaza Strip. That was at the end of July. What we now have is Netanyahu rejecting that proposal. So again, what you're seeing here is on this different front in terms of negotiations within the Middle East. It was just last October that you saw the initial ceasefire phase of that deal deal kind of implemented. Now, though, you're still seeing these kinds of, stalled talks when you don't have Netanyahu and Israel agreeing to a U.S.-backed proposal to try to alleviate tensions there. So again, just another front in which it indicates that the U.S. is struggling to kind of, bring some of these sides to the table and ultimately put forward these agreements. I mean, remember here, Shery, these are really, really complicated, weighty issues to kind of wade through here. And so the fact that you've got, the sort of back and forth in terms of what progress looks like may not necessarily come as a surprise.
Bloomberg managing editor Jill Dacis there. Well, shares of Sunrise Energy Metals are trading higher in the open here in Australia after President Trump announced a $3 billion investment in critical minerals mining, hoping to wean the US off China-dominated supply chains. Well, Alan joins us now with more. So what's in the announcement for Sunrise that's got investors so excited?
Well, $400 million loan from the US government that's going to put the US government at the front of the queue when it comes to getting Sunrise's scandium, which is the critical mineral that they mine. A lot of us probably never heard of it. It's used to strengthen aluminium. Scandium oxide also used in energy supply for data centers, that type of thing. So plenty of demand as well. And at the moment, a supply of scandium's all tied up by mainly China, also Russia and the Ukraine. So the US obviously very interested in diversifying its sources of that. Now, Sunrise has got one mine. It's about 6 hours west of Sydney in a very small town called Fifield. So this loan is going to be used to help develop that, get it up to speed more quickly, and expected to have first production in 2028. And we're hearing today Sunrise now are also planning to pursue a US listing off the back of this announcement.
The squeeze on copper continues too, and so much of this is again the tensions between the US and China, right? Is that why we saw Rio as well as BHP at this announcement as well?
Yeah, that's right. And the news there, important but not as fresh. This was regarding the Resolution project in Arizona, which when complete will be the largest copper mine in the United States, able to potentially supply about a quarter of US demand. So that's a joint venture. There's also a number of co-products there in the rare minerals space as well. So again, adding the interest to that mine. So a $500 million investment for that was announced some time ago. Production there due to start sometime in the mid-2030s.
It's particularly interesting and probably quite fortuitous for these miners, given that we continue to see the slowdown in China in demand.
Yeah, for sure. More the focus for this meeting, though, was more to break that dominance that China has over the rare earths space at the moment. So a key challenge here is making sure demand holds up, even if China makes moves to try and suppress the prices. So this is why this $400 million loan for the likes of Sunrise is so important, because it'll allow them to sort of weather those changes in the price and keep bringing that scandium to market.
Paul Allen there joining us from Sydney. And here are some of the other top global headlines that we're following. The Trump administration has introduced new tariffs and price floors on polysilicon and other key components used to make solar panels. Under the move, imported polysilicon derivatives, including silicon wafers, will be subject to 15% tariffs starting in December. The move is aimed at stopping Chinese-linked manufacturers from shifting production to new countries to sidestep existing U.S. trade restrictions. The U.S. is accusing China of using dubious pretexts to press its disputed territorial claims in the South China Sea. This after Beijing announced new rules for nature reserve at Scarborough Shoal last week, barring Filipino fishermen from the contested waters. The U.S. State Department has called the move destabilizing for the broader Indo-Pacific region. We have more ahead on the Asia trade. This is Bloomberg. Take a look at the Kospi, seeing a little bit of a rebound for the first time in 3 sessions. We, of course, have seen already 6 weeks of losses for the Kospi, a lot of volatility in this market. We're seeing some of that leverage being flushed out, but still a little bit of skepticism when it comes to foreign investors trying to get back into the markets. We're following Samsung Electronics, SK Hynix, as well as Samsung, seeing a little bit of gains today, but perhaps giving up some of those gains in the early session today. We're just 20 minutes in, and we're watching SK Hynix as well. Of course, a lot of volatility with this stock as well. Now reportedly preparing a record $71 billion shareholder return program. According to Korean media, the plan could include about $28 billion in share buybacks. Bloomberg's Asia Equities reporter Sang-mi Cha joins us now with the latest. Sang-mi, what do we know about this potential plan?
Shery, there are many different sources actually, and the consensus was actually gearing towards that 100 trillion won entire package. The 60 going to the buybacks and then 40 to dividends, or 60 going to dividends rather. But again, we're seeing that the consensus is drifting a little lower, just like you said, towards 70 trillion won. We still do need to see the exact number. We do not know exactly. The company hasn't confirmed yet until Friday when they said that they will be detailing the full context and the numbers in the third quarter. There are potential that they will be releasing these numbers late August, so that will be a lot closer than what we had anticipated. And all of this comes right after they had released that they're going to be spending about $38 billion in 2 fabs to build out DRAM and NAND in Cheongju and in Yongin. And this also, of course, comes after the July U.S. IPO, U.S. listing, where they raised about $27 billion.
I mean, SK Hynix is one reason we're seeing so much volatility in the broader Kospi, right, given its huge weighting in the index. Are we seeing some of that volatility retreating, some stability returning to the markets? I mean, it's been a historic reset.
That's correct. When you look at the volatility gauge for Kospi, it's actually 2 months low right now, coming down from that record high that we have seen in June. And we are seeing this because the deleveraging has been playing out. That, of course, was because of the forced liquidation in some of these retail accounts that we have seen about 1 trillion won wiped out in June, and again, the same amount in July. So all of this has kind of contributed to that lowering of this volatility. But again, we see that, and we still see the margin loans are still up. But again, that also has come down a little bit. That is the lowest in this year. So it is still at very extreme levels, but still it is something that is being washed out.
Are we seeing foreign investors returning?
Foreign investors, when you look at just the valuation of Kospi, should be returning. Kospi is right now trading at 5.1 times forward earnings, and that is the lowest even since the global financial crisis. But of course, when we look at it, a lot of the investors that we have talked to say that it is just not enough for them to feel comfortable returning. Looking at this volatility, the 5% moves ups and downs, and trading halts like sidecar and circuit breakers hitting on a daily basis. Of course, they say that they're also worried about the competition in the memory space. These Chinese chip makers making forays like CXMT and YMTC in the future. That has been also a lot of these headline fears that the foreign investors have been feeling. And they say that they do feel more constructive on the AI trade and on the memory side, but they want to express that rather from other markets such as Taiwan.
Bloomberg's Asia Equities reporter Sang-mi Cha there with the latest on the Korea market. And here are some of the other corporate stories that we're tracking. Berkshire Hathaway has spent about $4.5 billion to buy back its own shares in the second quarter. It also purchased nearly $20 billion of equities, signs that CEO Greg Abel is putting more of the firm's cash pile to work. Operating earnings climbed 16%, driven in part by gains in the conglomerate's manufacturing and service and retail divisions. Westpac is flagging caution on Australia's softening property market, with mortgage applications down about 20% since May. The lender saw an unaudited net profit of $1.3 billion in the last quarter, with growth in deposits and lending helping offset weakness. CEO Anthony Miller says housing credit growth is likely to moderate into next year. This is Bloomberg. Tech stocks leading the gains on the Kospi today as we're seeing a rebound after 2 sessions of losses and 6 weeks of losses broadly for the Kospi, of course, has been pretty volatile, a 40% drawdown from its June peak. You can see the Kospi and the Kosdaq gaining more than 1% each. The Korean won, though, seeing a little bit of weakness against the U.S. dollar. We had seen a little bit of support with 5 days of gains for the Korean currency on corporate dollar repatriation. Remember, we have big news like SK Hynix committing $38 billion to more memory capacity in the country. So really, when it comes to the chip boom, that's now feeding directly even into FX support. Let's actually talk about semiconductors. South Korean AI chip designer DeepX recently securing fresh funding at roughly 4 times its previous valuation, highlighting continued enthusiasm for companies involved in the AI boom. Its chips are intended for AI work and applications outside of data centers where power and cost efficiency are highly priced. Joining us now from Seoul is its founder and CEO, Lokwon Kim. Lokwon, really good to talk to you again. Congratulations on this fresh funding. How much of this will be used in developing your next generation chips, which I understand is in the works right now?
So we are raising the fund for the global business expansion and for the next generation chip designs for the generative AI and physical AI. So we are very actively working on developing the business in the global scale, and we're working on for the second generation chips for now.
What is critical when it comes to developing the chips? Are we talking about the business side of things as well, where you have to get more clients around, and where are you at?
Yeah, so now we have lots of requests about the generative AI capability in the battery-powered physical AI devices, such as robots, drones, and smart factories. So at the same time, power consumption determines battery life, heat, and system reliability. So our customers require low power consumption, AI capability for generative AI. So that's why we are working on 5-watt power consuming generative AI chips for the physical AI systems. So thing is, then our customer can use generative AI without any paying data center fee or token fee, or etc. So there will be free token machines in the physical AI systems in the future.
When it comes to all of those sectors that you mentioned, whether it's robotics, factories, where are you seeing the strongest willingness to actually pay for that?
We need to pay a lot of money for the data center and the generative AI processing in the very high resource consuming capability, but we will prepare the very decent level of the generative AI capability with the cost competitive product. Something like our product can be like around $100, but thing is for generative AI applications, well, our customers are paying more than that. That's why they wanted to have the low cost and processing, highly processing performance for the generative AI in the battery-powered devices. So now, we are seeing lots of movement from the AI in the data center to the physical AI systems. So that's okay. That's we are seeing the market. So our customer are working on the robots, toys, smart farming, smart cities, and smart factories, or many of the factories for the manufacturing.
Who are your biggest rivals, and what's your edge?
Well, in my opinion, right now we are working with humanoid robotics company. So this year we'll see the first, mass production for fully AI-enabled robotics. That means fully automated, robotics with the AI technology. Previously we have used rule-based program software technology to run the humanoid, but now we can run the humanoid without any rules. Only we can provide autonomous advanced AI so that they can learn how to operate the tasks in the harsh area and manufacturing environment. So the edge will be robotics and the smart factories.
But what about your competitors, especially around Korean startups? We have a lot of them right now that want to get in the same AI trade, semiconductor trade. And of course, you have the likes of giants like NVIDIA. So who do you consider your most direct competitor, and what's your competitive edge?
So our different, we have the outstanding difference in our technology in AI semiconductor. I mean, we are working on the battery-powered, devices AI capability. So the most important thing is, the power consumption. So other competitors, they are working on the, data center and huge-scale servers, etc. But we are focusing on the battery-powered devices. So in the physical AI systems powered by battery, the power consumption itself determines, battery life, heat, and system reliability. So, thing is, we need to have the ultra low power consumption and technology. So, because there's no physical AI without ultra low power AI chips. So the thing is, there's no clear leader in this area. But thing is, we already brought the ultra low power consumption technology. So our customers are recognizing DeepX as a leader in this area. So in my opinion, right now, for the low power, highly performance, the AI chips, we are the one of the global leader in this area. So we want to become a de facto standard, player in this area. So we have great momentum compared to any others. Also,
especially since earlier this year. Go ahead.
Okay. I mean, we don't compete with NVIDIA. We compensate NVIDIA business because they are very strong in the data center, but their edge or on-device solution consumes over 100 watts. That means, it consumes 10 times higher than laptop CPU. So we can, provide 5-watt power consuming, AI chips. So our customer can easily,
I think you've told me that logic as well before. You don't compete with NVIDIA. You're actually sort of complementing what NVIDIA does. But let's talk a little bit about your consumers, because earlier this year, you also announced that you had more than 30 mass production contracts across 8 countries. When do those orders hit your financials?
Yeah. So recently, we are receiving, several tens, almost 100 purchase orders from over 10 countries. So we are seeing lots of movement in the market. So we can see robots and smart factories and drones and smart farming and various. And every industry is moving very fast and they are evolving very quickly. So within consecutive years, we'll have lots of growth in this market.
So you're also earmarking specific capital for the U.S. market. Okay, that's a big market. The Japanese market as well. What's behind that logic of wanting to expand in this economy?
Yeah, so we are also working with gaming company. They wanted to have a real AI for their gaming. So at the same time, we are also working with printer and scanner companies in Japan. And then also Japan, industries are really interested in AI transformation from the traditional manufacturing industry to be the global leading, manufacturing industry. So also I can see the aggressive, movement in China and South Korea. But more interesting thing is, also we have lots of collaborations with European, manufacturing companies. They are working for smart factory, for the industry revolution 4. So that's why we want it to be de facto standard for these evolution in the industry.
Lokwon, before I let you go, I think I always ask you about the timing for your IPO. The fact that your Series D, you deliberately left aside to preserve some room for a potential pre-IPO cornerstone investor, does that make us closer to that timeline you have?
So recently we were receiving interest from multiple markets, including US, South Korea, Singapore, Nikkei, and others. But thing is, my focus is on establishing the global leadership in physical AI semiconductors. So, this year I can observe AI is rapidly moving from the data center to the physical AI and real-world devices. So once we can become, a de facto standard, player in this market, then everything, including valuation, IPO, and others, will follow after us.
Lokwon Kim, always good to chat with you, CEO at DeepX. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at some of the currency pairs that we're watching, particularly in terms of the direction of the US dollar. There's a few factors at play here. Obviously, the jobs numbers, we'll get some more details on that in just a moment. But the lack of progress when it comes to the reopening of the Strait of Hormuz, Iran pushing back against further talks as well. We're watching the yen in terms of how long this intervention is going to last for. 1 out of the 9 BOJ board members saying it's possible to consider the pace of rate hikes that is faster than market expectations. We're still passing through the summary of opinions from June's policy meeting that came out this morning as well. All of this is going to kind of determine how something like the Aussie versus the yen is going to trade. We're expecting a hawkish hold from the RBA this week, but the Australian dollar is poised at this point to climb back towards that 35-year high against the yen. The impact of the currency interventions looking to fade, the RBA's hawkish stance bolstering that differential as well. So we are hearing from multiple strategists that that could sort of continue the ascent for the Aussie dollar against the yen. But when it comes to those jobs numbers, a weakness in the payrolls data, Japan's intervention efforts have driven these major changes in FX and fixed income markets in what has been a short period of time. So let's get more on these dynamics. Our Bloomberg Markets reporter Anthony Stevens is with us now. So in terms of the change in positioning for the yen, what did we see post the intervention and as we got those weaker underlying jobs numbers?
Yeah, it's important to kind of re-examine the goals of the intervention, right? The goals of the intervention were to prevent one-way speculation on the yen. And to some extent, that has succeeded. So the latest CFTC data shows that hedge funds and other speculators have halved some of their speculative bets on the yen. So that's a pretty material repricing of that kind of expectation. We also see that in the vol market, USD JPY vol is materially higher than it was before the intervention. And from a pure price action perspective, you do have the yen trading materially stronger. It has broken moving averages. So in terms of both trend following and speculation, those positions are getting very challenged. Now you do need the BOJ to follow through. So it's very interesting to hear from that one BOJ member. And you need to see some weakness on the US side. And that was the context of the yen move in the jobs data. So the jobs data had some weakness in underlying trends around participation rates and wage growth, and that helped yen bulls kind of push price action. But what will be important is continued follow through from the BOJ, but also in the mechanics of intervention. So it was a very interesting start to see euros sold to fund yen buying. Will we see more of that? Will we see Japan tap those repo lines that Treasury Secretary Bessent kind of pointed them towards? It's the dynamic of the implementation which will tell market participants how sustainable this effort is and how widely the goals can be spread in terms of yen strength. Also, we have to remember there isn't any kind of target on the yen strength. It's not clear how strong Japan wants the yen to get. It just wants speculators to stop making easy money betting against the yen.
There's also this concern from Scott Bessent clearly in terms of where he would like yields to be. Have we seen more efforts from the US Treasury to try and keep a lid on the long end?
Yeah, and it's kind of related to the Japanese intervention, right? They want the Japanese to find other ways of intervening in the yen besides selling US bonds. And that adds to some of the concern around Governor Walsh's communication in terms of Fed meetings. There was a lot of concern in the absolute long end of the curve, in the 30-year, which spiked quite materially. And that kind of is very important politically because it sets the tone for mortgages. So that bringing down the yield curve steepness has been a big focus for Besant and other members of the kind of administration. But what is interesting about the jobs data is it actually exacerbates some of that move. So we saw the front end feel the brunt of that. You had yields lower, and the longer end didn't move as much. So it's very interesting to see how that plays out. Now there's a lot of focus on the minutia of the Fed's and the Treasury's like reaction function in fundraising. So there is a lot of speculation that the Treasury will move towards the short end to raise more money going forward and relieve some of the pressure on the long end, which has been under pressure. So what will be very interesting, the back end of this week is we have 10-year and 30-year Treasury auctions. How those go will give a very close indication of how market participants think the Treasury is moving that fundraising curve. And it will be interesting to see whether this yield curve flattens back down.
Markets reporter Anthony Stevens there with really insight into the U.S. markets, especially when it comes to those Treasury auctions coming up later this week, which we'll be watching. Here in Japan, we'll also be watching JGB yields. Really, the debt market remaining exposed to oil, the U.S. long rate pressure there that Anthony was talking about as well. When it comes to the Nikkei, we're seeing upside of more than 1% after 2 sessions of losses for this market. The yen also holding at that 157 level, but very close to 158, again weakening against the U.S. dollar. As we talked about, the soft U.S. jobs report, Treasury yields down, dollar down, had given a little bit of a boost to the Japanese yen, but that not necessarily holding in today's session. JPMorgan Asset Management's chief global strategist David Kelly now warning the markets are concentrated in 2 extreme ends of risk, especially among retail players who are heavily influenced by social media. He spoke with Scarlett Fu and Tom Keene on Bloomberg Money.
I think we've got sort of a bipolar market. I mean, people are either they feel like they've got to hit a home run and they put it all into Bitcoin or meme stocks or whatever, or they huddle in cash. And it's because I think people don't understand that the whole point about investing is not to come up with the secret thing that's going to beat the market. All you got to do is latch onto the market. You make a few basis points here and there from good management, avoiding stupid companies. But overall, if you just bet on the forest, you don't have to pick their exact tree. But what happens is we've really got 2 types. We've got those who are just way too risk taking, investing in Bitcoin or whatever. And then you've got a lot of people just huddle in cash because they're seeing what on the social media feed. And the social media feed is telling them you need to be very scared and you need to be very angry. And that is just preventing a lot of people from actually getting invested.
I want to talk about those young people who are going all in, going into Bitcoin, going into prediction markets. Do we assume that as they get older, they'll grow out of that mindset?
Oh, this is a key question.
Well, I think they can, and I think that institutionally we can help them out by just let's default, put some money into 401k. But I think it's also a matter of education. People really need to understand that it's Wall Street is not I guess even if you look at all these terms, you see all these numbers, all this confusion. It's not that difficult. It's about basically investing in American business, and if companies are making good money, they can pay that out in dividends or in coupons. Invest them. It's not rocket science, and I'm afraid sometimes people think it is, and therefore they think they've got to have some really smart idea to beat.
On Bloomberg Money, we avoid what's going to happen at Jackson Hole. What's the Fed going to do? But something we really want to know, in each and every firm, and you're advantaged by Kasman, Feroli, and the others, how do you use economics within wealth management, within retirement, within someone's personal finance?
Well, a lot of it, first of all, you have to figure out things like, okay, where's the dollar going, for example? If the dollar's been coming down for the last 2 years, if we think it's going to come down some more, that will amplify the return on international investments. Right now the U.S. is 64% of global stock market capitalization, which is an enormous number. And yet almost all American investors have got less than 36% of the money in international. Everybody's underweight international. And if you think the dollar's going to come down, put some in there. And then also just looking at different sectors. We can see where these AI earnings are coming from. They are very impressive. But also, recognize that, there will be bumps along the way. And the market is very concentrated. People's portfolios have drifted into being very concentrated. So you have to sort of try to get more balanced.
JPMorgan Asset Management Chief Global Strategist David Kelly there speaking with Bloomberg. We have more ahead. This is Bloomberg. Apple is reportedly testing memory chips from China's CXMT across its product lines. Let's bring in our China correspondent Minmin Lo in Hong Kong. And Minmin, if true, this would actually be huge, not only because we have the U.S.-China tech controls, but also for global memory makers. What do we know at this point?
Yes, this is according to the Wall Street Journal's reporting, and Apple is reportedly already testing CXMT's chips across things like its iPads to iPhones, particularly for sale of products that will be sold in China. And Apple is looking for the blessing of the White House to do so because, as you said, CXMT is blacklisted by the Pentagon, which means that U.S. firms cannot transfer technology to CXMT. So that means if Apple wants some sort of custom chips for its products, which it typically does, it will not be able to work with CXMT to communicate things like its product specifications and technical details. It will only be able to buy off-the-rack sort of chips. And that would require Apple potentially to redesign some of its product parts to integrate those CXMT chips. But certainly this tells you that the global memory crunch is hitting Apple hard, and it is looking to diversify its suppliers, and CXMT is one of the front runners there.
And coming at a time when China also wants to build up their own chip ecosystem, right? What would the implications be for all of these companies in China?
Yeah, that's right. We already see the implications through the earnings reports that are coming through. We're entering earnings season, and Cambricon is one of the earlier ones to report its first half earnings up by 108%. You look at some of the other Chinese chip makers as well. MetaX telling investors they were expecting a close to 150% increase in its revenue in the first half. Illiana, which is a Shanghai-based company, expecting a 3-times sale. And all of this is because the government has been asking companies to buy more locally. And according to Bloomberg Intelligence, which did a survey with Chinese tech executives, they found that Chinese firms are planning to spend close to half of their AI accelerator budget on locally made chips, as opposed to just 30% in June. And according to Morgan Stanley as well, if you pull up that chart, you would see that they are expecting locally made chips to make up 70% of chips used in China by the end of this decade. So certainly many of these Chinese chip makers will be able to benefit from this domestic substitution theme.
Bloomberg's China correspondent Minmin Lo there, and take a look ahead as we get into the first trading session of the week for Greater China. And we are hearing from Goldman Sachs analysts that you should diversify from China tech hardware into H shares on account of elevated market volatility for that shift into assets. This is Bloomberg.